Where is the crash? With nearly half of buyers today paying over $2,600 a month for a typical mortgage payment, everyone is wondering how and, more importantly, when this market bubble will finally blow up. When you scroll through the Zillow app looking at all the new listings in your neighborhood, I'm sure many of you are in pure disbelief. With rates now approaching 8% and home prices at levels higher than what they were last year at this time, most people have simply given up on the market for now. And this is reflected in shocking demand data we saw released just yesterday. You see, today's market is something that this country has likely never experienced in its history. On one side, we have record low demand, which most people would rightfully assume would lead to some sort of price relief, but instead, prices are keeping steady or in some markets going up even further. And this is because at the same time we're getting record low demand, we're seeing record low inventory. The supply side of the equation is so low that prices have remained strong as the scale has not tipped in anyone's favor. But this unique scenario has a major problem. It leaves the market susceptible to a major crash, and all it would take is a tiny spark that we have yet to see ignite. You see, the major crash everyone keeps hoping for isn't as far-fetched as many of the housing bulls make it out to be. To understand why, let's take a step back and look at some brand new data coming out of the Mortgage Bankers of America. But before we do, please just take 2 seconds and hit that like and subscribe button if you're enjoying the video thus far. Each like is a massive boost to the channel as it provides instant feedback for the algorithm to push the video. So please don't forget to press below. And now back to the fresh data. You see, because most people buy homes with mortgages, demand can be traced to the number of people applying for mortgages. And as of the latest reading, mortgage applications have been falling to extreme lows. From last month, this index, which tracks application data, fell 2.1%, leaving it at 141.9. This is the lowest reading we've had since 1995, and what it means is nothing surprising. Nobody wants to buy a home. There is very few people applying, and demand is extremely low when judged from a historical long-term average. In fact, from the most recent peak, which occurred in late 2021, this infamous demand reading has dropped over 50%, leaving it plummeting down to near all-time lows. But all of this shouldn't be surprising given what I mentioned earlier. What you should be worried about is the fact that this trend is setting up the perfect scenario for a massive crash. The entire market is just waiting on a spark that will come in the form of an inventory bump. With so few houses on the market, even small changes to the number of overall listings can have profound effects on prices around the nation. This is something that's even more so exaggerated by the fact that the housing market operates under the law of the vital few. This is also known as the principle of factor sparsity. Now, I'm not going to get into the mathematical details regarding this because it would likely put you to sleep, but what I will say is that this principle is the reason that a housing crash can quickly become a reality in a market just like this. You see, your home's value is really dictated by just a few sales that happen throughout the year in your neighborhood. The number of sales in the days before 2020 was likely 2 to 3 times higher than what it is today. Right now, it's very possible that in the last year, only a few homes have sold in your neighborhood since the start of 2023, so we can assume that the sale price of something as low as 3 homes has dictated prices for your entire neighborhood. In other words, 3 transactions have essentially repriced as many as 300 homes, and this expanded means that very few transactions actually dictate the price levels for your entire city. It's also the reason why the Case-Shiller, which is essentially an index that tracks home prices in the United States, can do something like this in a period that lasted less than 3 years. In the same way prices can rapidly go up, they can plummet in a low liquidity market, and with demand at near record lows, even a tiny bump in inventory levels would have serious effects to the overall pie. So now that we understand that really all it would take to instigate a crash would be a small number of fire sales, what could possibly cause something like that to occur? Well, just as it was speculated by many researchers in the last crash, this future crash would also come in the form of investor capitulation. You see, in nearly every market panic you read about throughout history, what really causes heavy dips is forced selling. In the stock market, this may be something like a margin call where a borrower essentially tells you you, you have to sell at a certain point so they can at least recoup some portion of their borrowed money. In real estate, that will look eerily similar. Investors who are rapidly losing money will be the first to dip. This fact is always true. Investors have the most incentive to sell. Regular, hardworking people, even if they bought an overpriced home they can't afford, they will fight hard to keep it, as more often than not, they have way more to lose. This is their primary residence at the end of the day. So if the crash will start with investors, how and where is the next question. We know based on the latest reports from Redfin that investor activity is drying up. Rates have simply gotten out of hand, and since most investors operate on margin or borrowed money, a lot of real estate opportunities have dried up. There just isn't enough money to be made as price growth has slowed and rates have skyrocketed. Now, just as in the past, the largest cities we see investors operating in are your typical bubble candidates: Vegas, Phoenix, and Miami. This is also where the last crash started, and as evident by the massive post-2008 losses, it's also where the crash hit the hardest. Today, we're seeing a repeat of history. At one point last year, investors were buying up 1 out of every 3 homes in Phoenix. It's speculated that in some neighborhoods, it's 1 out of every 2 homes that was an investor. This type of activity is exactly the type of environment where the buildup to a crash can quickly escalate. Going back to the principle I mentioned earlier, in neighborhoods like these, as soon as one investor gets a whiff of panic, the fire sale begins. And just like that, a few dozen houses have reset the valuations for the entire city, and the whole thing cascades to other metro areas throughout the United States. If you want to see evidence for this, look no further than Vegas in the post-2008 world. From 2006 to 2012, prices declined 62%. That type of panic doesn't happen without investor speculation and greed. In the same way prices can rapidly accelerate up, they can also rapidly accelerate down. During one infamous stretch in this crash, prices seemed to be headed towards zero. From October 2007 to October 2008, the average Vegas home lost 28% of its value. And that's just an average. In the real world, certain trendy neighborhoods lost even more. It wasn't unheard of to see a Vegas home that was selling one year for $300,000 to be $150,000 the next year. The market over there quite literally dissolved overnight because investors quite literally made the house a tulip. Once the mania was over, as you can see from this chart, the results were catastrophic. It would take Vegas over 15 years to recover past its 2006 highs, and for many people involved in real estate, this meant that they were wiped away. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed the video, and make sure you leave a comment below, especially if you got to experience the great 2008 Vegas crash, an event that we could see repeated in the coming years.